Hey everybody, welcome to my trading game plan. My name is Gareth Soloway, Chief Market Strategist here at verifiedinvesting.com. So first and foremost, we're going to get into the nitty-gritty here. As always, it's no BS, just charts. Now again, the reason that is because there's lots of places to go get hype on social media, narratives on mainstream media. But what I found in my trading career, which now spans 26 years, next year 27 years, is that when I listen to that, I usually lose. When I focus on the charts, they give me a probability-based assessment, and then I can make an educated, high probability decision, and generally I'll make money. And that's what I try to bring to you guys, cutting out all the nonsense that we deal with in everyday life with all the hype. All right, so let's dive right into the charts. S&P 500 here. What we're seeing here is the S&P futures are trading slightly higher. This is coming on the back of yesterday's decline. So yesterday we opened flat on the day. You can see we had a pretty continual decline all day long. It really did accelerate around this 12:30 time frame into 1:30. The reason, by the way, for that decline was Jerome Powell gave a speech. And in that speech, he not only said equity prices were extremely high, stock market prices extremely high, but he also said that it's contributing to inflation. And again, anytime you have the Fed starting to say, hey, listen, the stock market is hurting inflation or keeping it higher and pushing it higher, that is something we as investors need to pay attention to. In addition, he did talk about the weakening labor market and basically telling us that there was no good direction. If the Fed cuts rates, then you have inflation going up even higher. If the Fed doesn't cut rates, then the economy and the labor market spirals into recession. And the market, again, we heard this almost exactly from last week's Fed decision, but the market, because of the next morning, we had Nvidia investing $5 billion. We kind of, in the news cycle, it got forgotten very quickly. And yesterday, he reiterated that. Now, we'll see if it gets forgotten again in the news cycle. But that, again, is being reiterated by Jerome Powell. Now, one other thing we have to talk about, right? Nvidia. So Nvidia announced a couple days ago that they would invest $100 billion up to, and I pointed this out yesterday, up to $100 billion in OpenAI. Now, the stock initially rallied on that, and then yesterday it came right back in, closing on this wedge pattern trend line. Now, when you break above up any trend line of significance, you need to confirm, guys. I can't stress that enough. Otherwise, it could be a fake out, right? And the confirmation signal is something I created a decade ago to help me really isolate down when is it a real breakout versus potentially a fake breakout. And it's not to say that if it confirms it's 100%, right? There's nothing in trading that's 100%. But it basically takes the odds from one close above a line or below a line that it's a real breakout or breakdown from basically 50-50 to 60-40, slightly favoring, to about 80% that it is a real breakout. All right. Now, in this situation, Nvidia closed above, and then the next day we reversed. So obviously we didn't confirm whatsoever. It'll be interesting to see what happens today. But my point of bringing this up is, number one, they said they would invest up to $100 billion, and I said this yesterday, so they could invest $1. That's technically up to. I mean, it's below. They're just saying they're not going above 100 billion. But there's a bigger problem here. All right. The bigger problem is this. Nvidia is investing 100 billion. Let's say they do the 100 billion in OpenAI. So OpenAI can turn around and buy Nvidia chips. That doesn't seem kosher to me, right? There's something wrong there. So basically, Nvidia is basically pushing their own demand by saying that, all right, we're going to invest so that this company can buy our chips with that money. And the point being is that we've heard how great the backlog is in all of these, chip players. Nvidia has a backlog that's massive. Why are they feeling the need to give a company $100 billion so that they can turn around and buy chips? Is demand really that strong? And is that a good thing? Do we want companies essentially building these kind of pyramid schemes where they're financing their own demand for their chips? Just throwing it out there. I bring things that you may not be hearing in mainstream media to your attention, but this, my friends, is something that to me sets off a little alarm bell. Listen, it's not a big alarm bell yet, but again, it is a little alarm bell. All right, let's get back to some charts. Let's flip over to the S&P. So the S&P yesterday, I went over this, right? And again, I'm going to go over it briefly today because it's so important on a technical analysis basis. And what we basically are looking at here, this is your COVID collapse and recovery. This was your Liberation Day collapse and recovery. Now, again, if you take this, and I saw some confusion in the comments, and this is why I'm addressing it. People were asking, well, how do you get 1.8 as your multiple to figure out what the high end should be? And the only reason I'm getting that is because that's actually what the multiple is, right? So if you take this drop of 35.45 and you multiply it by 1.8, right? 1.8 times, you get this exact rally in 6 months. And this is important, guys. This was 6 months of trading, right? In 6 months, you got this number. So what I did is you basically say, okay, well, here's the rally was 1.8 times the drop, right? So now let's do the same thing. If we take this drop for Liberation Day, which was 21 and change percent, and we multiply it by 1.8 again, right? So let's do that again. We multiply it by 1.8 times. Interestingly enough, what do we get? We get the exact rally that has occurred in the S&P here. And more importantly, it's like, listen, I mean, there always can be over time, but in exactly 6 months. And that, my friends, is interesting to me. Now, what's even more interesting, and one of the reasons why I think we're going to have a correction in October, and maybe we're even starting it now with the way markets reacted, we'll have to see. But the reason why this is important is that we saw in the COVID collapse and recovery, after that 6-month period, we saw a drawdown of 10.5%. So it does imply that we should see some form of a correction here if everything is matching up. Now, again, could it be a percentage, just like this was 1.8 times these numbers? Maybe it's not 10% because we didn't rally quite as high, but in the very least, you should be looking for a 5 to 10% correction or pullback. Now, please understand that that doesn't mean that I think, once we correct 5 or 10%, we're going to go right back and make new all-time highs and just the party's going to keep going. It could, but overall, we're talking very short term here. Coming into October, I'm looking for this 5 to 10% drawdown in the markets. Once that happens, or if that happens, then I'll reevaluate the charts and we'll go for projecting out the next couple weeks or the next month out on the charts. All right. The other thing I think is important to look at here is the NASDAQ 100. The NASDAQ 100, I have this trend line that goes back to the COVID lows. It goes right to this pullback where we bounced, we broke, and then look, every time we're hitting, we're getting a pullback. Now, what's interesting here is that if we look at the pullbacks off this line from the underbelly, let's look at how big they are. This one was a 16% pullback. This pullback was a 25% pullback. So again, the question has to be asked is, should we be looking for something in one of these ranges? Or maybe if we average these two numbers, could it be as big as a 20% pullback? Right? I mean, if you take 15 and 25 and you average them, it's 20. Now, listen, again, could it be 15? Could it be 10? Yes, it could be any of those. But as a technician, I'm always thinking about the possibilities. Like if we're seeing this type of pullback multiple times and it's this amount, do we then say, okay, we're setting up for this bigger correction in the NASDAQ? All right. Now, the NASDAQ is the one that's led the markets, right? I mean, it's basically been the AI trade. But then if we go back to what I said just a little while ago, how is an investor, like if you're an institutional money manager, you basically have to be long the markets because you can't be left behind. But at the same time, when you see Nvidia investing $100 billion into a company that then is expected to turn around and buy Nvidia chips with that, how does that not make you uneasy? Like, is that healthy? Is the patient being the market healthy here? And that's, again, something that we have to just be aware of. And I just point out stuff like this that you're not going to hear a lot in mainstream media, but I do think it's important. All right. So the dollar is getting a big bounce again today. I find that interesting. So the dollar, again, when the Fed announced their cut, we dropped initially, then we rallied back. We did have a couple pullback days on the dollar, but now the dollar is actually starting to turn up even more. That is interesting to me because, again, in theory, with the Fed cutting rates, most people would assume, oh, the dollar is going to weaken and the 10-year yield is going to go lower because the Fed's lowering rates. It's not doing that. That also is something that is piquing my interest potentially as an obstacle for the market. The 10-year yield, same thing. This was your low on the Fed. It rallied up. We had a pullback yesterday. It's going right back up. Interestingly enough, look at this. We closed above. We didn't confirm above this trend line. And there we did confirm. So yesterday when we pulled back, this became major support because we confirmed above it. And sure enough, we're getting a bounce over it. Obviously, I'll continue to monitor it. I love looking at this daily 10-year yield chart on the weekly. It just looks so much better in terms of how crisp this trend line is. And you can see that even though you pierced it, you keep on getting bought up. The yields keep coming back up. And again, folks, the reason why yields going up when the Fed is cutting rates is so bad is because basically what it's telling us is that, number one, either the market thinks inflation is going to go up and the Fed won't be able to cut as much as they think, or it's telling you that foreign buyers of U.S. debt are not willing to purchase our debt for lower interest rates. Like if I'm a country, right, and I'm like, oh, I got a call from the administration saying would I like to purchase, $50 billion of treasuries. Am I going to be okay on a 10-year or a 20-year only getting a 4% interest rate, even though I look at the U.S. debt and I'm like, dude, these guys, what are the odds of me actually getting paid back? Maybe pretty low. I want a little bit more in interest to take that risk, right? Remember, when you're given interest, the higher the interest rate goes, you're willing to take a little bit more risk on that debt. Like if someone said, hey, listen, I have to sell some debt here. Would you like to buy this? Listen, my company's not super firm, so there is some risk. You're not going to be like, oh, sure, you pay me 1%, I'll give you this money. You're going to be like, give me 20% interest, right? Then I'll take the risk. That's the point. That's what's going on here, and that's the risk in the market. All right, so let's go on here, folks. Couple other things that are getting my attention. There are more and more topping tails forming. Topping tails, if you're a technician out there or if you're learning, what is a topping tail? It's a bearish reversal signal. Yesterday, we had topping tails galore in many, many charts. What were some of them? Right here, the Dow Jones Industrial Average. This is a topping tail. That is a bearish reversal signal. Now, what's amazing is we're still stuck inside of this tight wedge, but basically, there's no place to go. Like we're either going to have to break above or below this wedge. You now have a topping tail here. So this, again, more and more signs that the Dow looks tired and potentially going to break down. Another major one for economics and the economic demand of the economy and how strong it is. Caterpillar up until to yesterday was doing great. It then slammed into this trend line and put in, what's that? A topping tail. How about Goldman Sachs, one of the biggest banks out there and one of the biggest financiers, right? I mean, they do a lot of hedge fund trading, all that stuff. Look at the trend line, topping tail. Okay. So again, my job is to bring the basically insights that maybe you're not picking up on. You might not have seen the Goldman topping tail or the Caterpillar topping tail or any of these other things. And it's just for me. And I basically, to me, in these game plans, these my trading game plans, it's all about getting out what I'm discovering. I just get it out. I just throw it out to you guys. You take it and you do what you will with it. That's really the goal here. It's to give you information that you otherwise might not get. And these are things that I'm seeing, and I'm like, okay, so not only is the QQQ into that COVID trend line, then we've mirrored the S&P rally, 1.8 times rally in exactly 6 months, which is what happened in COVID before a 10% drop. Then you look at the pullbacks off the line on the QQQ, one's 15%, one's 25%. We just hit that trend line. Then you look at the topping. You guys get my drift here. It's starting to look at the smoke building. Is there a fire here? Now, maybe by next week, we'll look back and be like, nope, I guess it was business as usual. Everything just went up and made new highs. But at least for me, these are things that I pay attention to. It's risk assessment as an investor and a trader. Okay, on to a few other things. Rigetti. Oh, Rigetti. What a rally on Rigetti, guys. Up 143% from this low here in early September. I do have a level that I'm monitoring here, $34.50. If it hits it today, look at the beauty of this parallel. Now, again, I'm very careful when I short Rigetti because it's such a powerful runner, but finally it's getting up there. It's trading at 32.30 right now, so it would have to go a little bit higher during the day, but 34.50 on Rigetti finally gets to a resistance level so extended, RSI at basically 90. But if it gets up here, boom, there's your parallel. Look at how it's behaved down here. You connected to that previous high and you get there. Now, a few days ago, I drew this parallel in for myself a few days ago, and I was like, oh, Rigetti has no chance of even getting close to that. It's so much higher. And then lo and behold, here we are, right? Amazing stuff. So watch that level. That's on my radar. I haven't even talked about Micron. Micron reported earnings yesterday. Remember Micron going into earnings, and I covered this yesterday in my trading game plan. I said to you guys, listen, Micron's already up 43% going into earnings just in September. So I said basically they're going to have to cure cancer to have a big move up. Well, they had very good earnings, frankly, but they didn't cure cancer, needless to say, and they weren't going to, right? And my point of using that analogy is like it's almost impossible for them to report something after the type of move that we saw going into earnings. Look at the daily chart move. Now, you see this line? Look at this, guys. This is so cool. So this was my resistance line, 175, right? Approximately 175. Look at what we hit after hours before we sold off. Boom. And then we came in. Isn't that cool? Very cool. Now, Micron is trading basically flat. In fact, this is where we closed. It's virtually flat. I wouldn't be surprised if this is down as much as 3 to 5% today, just because you will have investors that were buying it specifically for a Oracle type 40% move up, and they'll be disappointed and they'll sell. And so there's going to be some selling pressure. The question is there enough buyers at these levels to kind of absorb that selling pressure? So just keep that in the back of your mind. All right. Freeport-McMoRan, some bad news this morning on that. That one's dumping out. Hasn't really affected the GDX just yet. If we look at the GDX here, again, GDX is basically flattish on the day, maybe slightly down. But again, it's not really impacting. But again, Freeport-McMoRan coming in pretty sharply today on a little bit of negative news. Freeport's, again, had a pretty good rally. It's not keeping pace with the GDX, obviously, and the gold miners. But for me, as a trading opportunity, I might be interested for a quick day trade at a break of $40. And then I'll start looking a little bit more closely around $38.40, this low pivot, and kind of reevaluating. There should be some good support down there. LAC Lithium Americas is up sizably today. This is an under $1 billion company, but the news here was that the Trump administration is thinking about getting a 10% stake in them for giving them some money, essentially, for giving them a loan. And so the stock obviously ripping higher. But again, the idea here is that the administration's looking more and more at having pieces of companies they view as being key to national security, right? So having lithium, right? We have to be able to produce our own lithium, having a stake there, and maybe some of the other rare earths, right? Things like that. And I think that's what's really going on there. All right, Bitcoin. Bitcoin getting a bounce today after multiple down days in a row. It has not tested the neckline of the head and shoulders yet. That's your first area of support around 110,000. Again, we talked about this level as being resistance. It worked perfectly. But really at this point, I'm just watching to see what happens if we get to 110,000. Does it break? Does it bounce? Gold today is up fractionally. I unveiled this parallel yesterday. It is an amazing parallel. So far, it is holding intact. We kissed the upper end yesterday. We pulled back, and today we're up slightly, but still below that parallel. Now, remember, you could break above this parallel, but as a technical investor, I have to be respectful of that parallel until it's broken above, especially with such a vertical move in gold. Gold short term is one of the most overbought in 25 years in the near term that gold has been, right? In 25 years, it's almost never been this overbought. And so that also just adds fuel. Like, listen, I love gold and I still have my long-term holdings in gold, but I'm also a realist and says it's healthy for things to pull back a little bit. And so if it pulls back and consolidates back to, let's say, 3,500, okay, now buy it again. Let's go again, right? And that's kind of the thought process there. Silver, let's take a look at silver here. Silver is hovering right into that zone. Remember, I gave you that $44 zone right here. Again, that zone, for those of you that may be new, that resistance comes from this pivot high in late 2011. So for me, at least, I look for a little stall, maybe a little bullish consolidation, and then we watch for a breakout to the upside. Oil and natural gas have been somewhat on the quieter side here. Oil is inching up just a little bit here, but it's still stuck between resistance, which is now at 66.60, and support remains at $60.65. So again, I show these charts every day, but I'm not going to spend time on them because there's no trade there, right? No sense in us wasting time when there's so many other things to look at. And same thing for natural gas, guys. Nat gas, again, just a whole lot of chop. It's been above that former trend line, below. I actually took away the trend line because we chopped so much now that I don't think it has much relevance at this point anymore. It's really just waiting to see, like, really, if what we want to put in on this is basically you have a parallel, right? You're basically just stuck in this short-term parallel. And I'm just watching to see, well, which way does it break? If it breaks here, okay, down to this low area. If it breaks to the upside, you probably head up to that 360 level on nat gas. All right, guys. All right, so listen, lots to go over. The markets, again, to me, are at, for me at least, a pivotal point where I want to continue to monitor. Doesn't mean we can't go higher. Listen, that's been the trade all along. All along, it's been, yeah, we get a one down day in a row, and then that's it. We don't get, when was the last time we had two down days? I don't even remember at this point. But the point being is that we know we're extended. We know the bulls are immensely. Even institutional money is now at one of their highest investment points, while insiders continue to dump. CEOs, CFOs, they just continue to dump nonstop. Retail is now invested. By the way, one last thing I'll tell you about. We have a time here. So I saw this headline. Someone brought it up to me in the live day trading room yesterday. The headline was, there's still 7.5 trillion in money markets. So there's still so much money that can come into the market. That is a BS headline, and I'll tell you why. If you go back in 2000, how much money was there in the system? What was the market cap of the entire market? Now, mind you, the semiconductors, that sector alone is 10 trillion now. And so if you look at it in percentage basis, it's actually very low. Like, because there is so much money in the market cap of the entire market is so massive now, 7.5 trillion in money markets is actually less than in previous points going into potential collapses. And so just be aware, taken out of context, it sounds, 7.5 trillion in money markets. That's huge, right? But wait a minute. If you just add up Microsoft or Apple and Nvidia's market cap, you're at $8+ trillion. So basically, like, just imagine spreading let's just say that half that money comes in the market. What's 3 trillion, 3.5 trillion going to even do to the stock market? Like, that's not going to make it go up. Like, if that money was just put into the large cap, the $1 trillion companies, that would only make them go up like 10% at this point. 10%. That's it. And so, again, I just point this out. You have to compare. So in the dot-com era, or 2007 going into 2008, it might have only been, let's say, $1 trillion or $2 trillion in money markets. But based on the market cap of the entire market, that was actually a bigger percentage, because we didn't have $1 trillion companies back then, than 7.5 trillion now versus what the market cap is. Massive market cap in the market. So my point being is that when you read these headlines, what does it do? It makes the retail investor get really bullish. Like, this thing can continue to rally. 7.5 trillion on the sidelines. Got to look at the fine print, guys. Just like Nvidia saying, I'll invest up to 100 trillion in OpenAI, but maybe only 100 million, and they'll use it to buy our chips, right? We got to look at the fine print. We got to take our head out of the sand and look at the fine print. Listen, as you guys know, verified investing is all about no BS, just charts and data. I'll break it down. I'll give you guys it straight. That's what I do. That's what we do here. And I thank you for your support. Seriously, guys. I wouldn't be on here if you guys didn't support us. There would be no point for me to come out and give you guys this information, right? So thank you. Spread it to your friends. Give them the link. I want these game plans to be averaging 100,000 views right now, 30,000-ish. Let's get it to 100,000. This is information that every retail investor should know about. It's our only way to fight back against big money that just keeps on becoming bigger money. Have a good one, guys. Thanks again for tuning in. Talk to you soon. Take care.